Okay. Hello, everyone. Welcome to Unit Master 6 weeks program. We are now in week 3. This week, we are speaking about the different projects and what's up in the blockchain ecosystem. And we have Christopher with us, who is a co-founder of Finoa, which is one of the leading digital assets custodians in the market. And he will actually explain what is actually their service and why is it so important. And hopefully Christopher will also share about the evolution of the security of assets. It's very, very interesting. So welcome, Christopher. I share the stage with you now. And then what will happen after you share a little bit of your presentation, we'll have a moderated Q&A. So all of you guys, welcome to put your questions into the chat, and then I'll read them out and we can have an interactive discussion. Thanks a lot.
Cool. Yeah, thanks for the intro and thanks for the invitation. Yep, first of all, a pleasure to meet all of you. I haven't seen the survey results yet where everybody is from, but just looking at the names, I think it's an audience all over the world. I think we have 45 minutes here, but we have 60 minutes.
We have time until 6 p.m.
Okay, yeah.
Typically we have also 10 minutes of networking at the end, so that people can exchange about their takeaways from your sessions in smaller groups.
Okay, very cool. So then, yeah, maybe we do it. I speak like for 20, 25 minutes, and then we have like 20 or 25 minutes as a Q&A. So maybe a very quick introduction to myself before I share my screen. So Christopher, one of the co-founders of Finoa, German born and raised, have a history in banking and in consulting, and then started Finoa beginning of 2018. Before I explain what we do in detail, maybe very briefly, and you will see that over the course of the presentation, we started as a digital asset custodian and moved into, let's say, a full service platform over time. And this is still the roadmap we are doing. And maybe quick look at the agenda and what we want to speak about today. I think now you should see the presentation, which we can start as a full screen. This is a little bit about my background. As said, started in banking, worked at BHF Bank for 2 years, then switched to McKinsey. That's also where Yip and I got to know each other, working for the same client. And then since 2018, co-founded Finoa. And main topics of today's talk will be trust in general. And it will go a little bit into a philosophical aspect. What is actually trust, and whom do we trust, or how do we trust? And then move into what is actually the core, let's say, business model of Finoa, i.e. building institutional trust in the crypto space, and convincing institutional investors to enter the space. And then I leave some room for Q&A. Maybe jumping into the topic. What is trust? So trust has 3 different building blocks, if you want to summarize that. And I highly recommend everybody, if this talk is interesting, to check out the link in the bottom in the source. So there's a lot of stuff from A16Z, which they are actually have researched about the end of centralization and the future of trust. And I picked a couple of let's say, slides or information from them as well. And this really explains what is decentralization, where is crypto built on, what are the elements of blockchain technology. But in general, trust has 3 different building blocks. So on the one hand side, you have incentive structures. On the other hand, you have social elements, and the third part is math and physics. And what is behind those 3? So incentive structures go back to the very, very early stages, when we were like in the Middle Ages, or even before, in the early days of humankind. So people trusted each other based on a personal connection. And why did they have this personal connection? Because they had the same incentive structures. So they had to survive. So basically somebody had to hunt, somebody had to take care of the home at home, and they had the incentive to work together and to trust each other. Those incentive structures moved more and more into so-called social elements, and we will see that later, maybe on this slide over here. So there was a shift from we trusted each other as persons to we trust in institutions, we trust in intermediaries. And I think there are plenty of examples. So we trust, or we used to trust our banks. We used to trust our central banks. We used to trust our governments. And this basically started when there were the first, let's say, communities, kingdomships, etc., built. But what you see, and I think it's a movement since the early internet days, which is accelerating, is that this trust in institutions is more and more moving forward to trust in machines, in programmable things like self-driving cars, for example. And I think one example of this is also what we see with the blockchain technology. And I mean, we go a little bit more in detail on that later, but if you just think about what's happened over the last 20, 25 years, the trust into institutions, into organizations became less and less. And I think there have been a lot of happenings or incidents over the last, especially 10, 15 years with the financial crisis, the Euro crisis. We have the big companies like Google, Amazon, Facebook, and so on, growing bigger and bigger. And I think this trust from institutions to the trust of machines, or programmable trust, how we call it, is evident. And this is also something which is an underlying factor of what we see in the crypto and in the blockchain ecosystem. As a couple of examples, so this is how the traditional financial system today looks like. So in the middle, you have like a bank, commercial bank, for example, and then you have all the different players in the community and the society basically working together with them, and they are acting as an intermediary, right? So you have the families, you have the companies, you have governments, you have NGOs, and so on and so on. And banks are really like the intermediary of those things. And if you go a little bit higher in the banking sector, if I would show you the picture how banks and central banks work together, it's exactly the same, because then the central bank would be in the middle and all the other banks would basically be there. And I think this is a very, very good example of a centralized system and the trust we put into institutions, because we nowadays 100% trust the banks, and there with the central banks, with our wealth, with our capital. Another good example is the internet. I mean, when the internet started, it was a different trust model, right? So the Web 1.0, how people call it, was not there to enable companies like Google, Amazon, or Apple to build the applications on top of it. But the simple idea of the internet was to enable peer-to-peer communication. And this was also like the first, let's say use cases which happened on the internet. And what happened back in the days was that people really interacted on those what we call internet protocols like HTTP, SMTP, DNS, and so on and so on. But what happened in the Web 0.2 area was that those big corporations like Google, like Amazon, like Facebook, like Apple, they basically built the application on top of those technologies. And what you see is that nowadays, 99% of the people don't know about the underlying internet technology anymore, but they just basically know, okay, like Google is my connection to the internet. And basically, we don't communicate peer-to-peer anymore, but we go into a centralized direction again. And I think, what did we lose over time? Obviously, personal security, privacy, and data sovereignty. And I mean, we could go into detail for each of them, but I think it's pretty obvious that privacy, yes, we lost that if we have an intermediary in their data sovereignty as well, and personal security as well, because what you see is like if information are being centralized, there's one single point of failure. And I think history has shown that if there's a single point of failure, it's always more risky than if you have the data stored decentralized. And then what we saw since 2009, and this is basically an extract of the Bitcoin white paper, we saw a new movement against this centralization with a white paper of Bitcoin, which started basically the whole journey or the whole ecosystem around cryptocurrencies, around blockchain, around technology. And this system, I think you covered that in a couple of further sessions before. This looks different. So we do not have any intermediary in the system anymore, but it's a decentralized system. And people do not have to trust one single institution, but they basically trust a network, they trust the community, and they trust the technology. So what we basically have seen with this is that we move the trust people put into things from an institution to technology. And this is something, if you think about it, what's really the underlying cause and the underlying factor of crypto. And especially if we take the example of Bitcoin, like what is the strongest use case of Bitcoin? It's the store of value, because people do not trust into their banks anymore. People do not trust into central banks. And they basically say, okay, Bitcoin is a currency which cannot be printed like the US dollar or like the euro by any central bank. So this is basically preserved, and it has like a, how do you say it? It has a limited supply, and algorithms and technology protects for inflation. And I think this is something which everybody knows. But if you think about that from this angle, why do people believe in that? And what does it have to do with trust? I think it's a very powerful thing. So basically, what we have seen is that we are entering in a new era of trust, and this is kind of programmable trust. And I think crypto is one example of that. But if you go outside of the, let's say, financial industry, there are also a couple of other factors and movements which you see. So secure messaging apps like Signal, like Telegram are increasing in popularity and reputation. Google, Facebook, and so on are in some countries really losing customers. And I think this is a movement which you see all over the place. And I think crypto is basically, and digital assets, digital token are the underlying, let's call it currency or fuel, which is driving this whole movement into a more decentralized world, which is basically, it's a movement away from institutional trust to programmable trust. The big question in this is, we are talking, if we talk about programmable trust, we are talking a lot about technology. And I mean, let's face it, 90% of the human population is not very technical. Or let's say even 99% cannot code and can't read a code. So how do you build this trust? And especially, how do you build this institutional trust? And this is a little bit the problem we as Finoa are facing or trying to solve. So as said, crypto is fundamentally different than what we have seen before, because it's rooted in a completely new trust paradigm, and it's a completely new technology which people do not really understand, and especially institutional investors are missing, on the one hand side, an access point, a gateway into this technology. And the other thing is they are missing a regulated entry point into this, because if you talk about institutional investors, they like to have a secure and regulated environment because they are managing third-party capital. And this is basically,
Just maybe to jump in, for those who are not so familiar with the finance world, what's the difference between institutional investment and then, I guess, retail investment, or however you want to make the definition?
I mean, so individual investors are basically people who invest their own money. To put it very simply, institutional investors or also professional investors are people who are managing third-party capital. So basically, they have customers. Those customers trust them with the capital, and let's say the task for them, the job is for them to preserve the capital or to generate returns. So you can think of, on the one hand side, I'm managing my own capital, and then on the other hand, I'm managing third-party capital. So I'm trusted with third-party capital, and I basically am the manager of this. Obviously, what's my job? To preserve the capital, to save the capital, but also to generate yield and generate return on that.
Can you just name some of the big players so that people can have some context in there?
I mean, in the traditional world, obviously, it's like, who are the big institutional players? It's like those asset management firms like BlackRock, State Street, Bank of New York Mellon, and so on and so on. So those who have those mutual funds, that's maybe in the equity and bond space, but also private equity like Blackstone, KKR. So those, let's say big private equity firms, the hedge funds like Bridgewater Associates, maybe somebody has heard about them. So there's a huge variety, so which ranges from really like big asset management firms, but also to family offices, for example. So people who are trusted to manage the capital of very rich families. So it's a very, very huge segment. And just if we talk about numbers, in the traditional financial world, I think 85 to 88% of the capital is managed and let's say owned by those institutional investors. So they are by far the majority of the market.
And how about these crypto funds and so on? Would they fall under your categories?
Yeah, absolutely. Because I mean, like crypto funds are also, they are compared to the traditional institutional investors, they are still very small. I mean, we have to admit that the market capitalization in crypto, yes, it's increasing over the last couple of weeks and also like years. But if you compare that to the capital which is managed in the traditional financial world, it's still very, very small. And I mean, yes, you have crypto funds who are managing 3 billion, 5 billion. So I think Andreessen Horowitz just raised a third fund, which was the largest crypto fund raised ever. So they are still small, but what you see is that on the one hand side, those, let's say, crypto native institutional investors, they are increasing and growing. Maybe that's the better word. But what you also see is that more and more traditional institutional investors are getting into the space. And only to name a few, I mean, you heard about the corporates like MicroStrategy, Tesla, and so on over the last years. But you also see more and more hedge funds moving into the space and deploying their capital there. So I think if we talk about that, yes, institutional investors from the traditional space will also move into crypto. And then we are talking about completely different volumes than what the crypto native investors have at the moment. And I mean, our customers are those crypto funds, and we see that they are growing like by 100x from, let's say, their first fund to their second fund. So one of our customers, the first fund was 1.5 million euros, which is basically neglectable. Second fund was 15, and the third fund is now over 100 million euros. And this all happened over the course of 2 to 3 years. So you see the growth in all aspects. So on the one hand side, crypto investors becoming bigger and bigger because they are entrusted by large, let's say, family offices, by large pension funds, insurance companies, and so on and so on. But you also see more and more traditional money flowing into the market. Good. But since we have been talking about those institutional investors, I think what they are really missing and what prevented them to get into the market 2 years, 3 years ago was that they didn't face an infrastructure which they were comfortable with, and they didn't have the regulatory certainty they most of the time need to enter the market. So basically what they were missing was trust, usability, and agility. And maybe this is also explaining why we as former McKinsey consultants said, okay, this is worth going into that market. So one of my co-founders and me, also former McKinsey consultant, we sat together in 2018, beginning of the year, and really said, okay, we as, let's say, individual investors are missing this regulated, sophisticated interface to really be comfortable investing into the market, participating in the market, like trading, like staking, but also first of all, securing our digital assets. And this is basically to tell you a little bit about the story, how we started. So we had the same problems institutional investors have, but obviously we had them at a way lower scale. So institutional investors, as said, they are managing way higher capital, nearly 90% of the market, and they're managing third-party capital. And the problem when you manage third-party capital is that you are also liable towards your limited partners, so towards your customers and your investors. And therefore, they need to have a completely different management solution than retail investors. And this is basically the problem we as Finoa started to tackle. And I think now being in the market for a couple of years, what we see ourselves and what we also envision to do is that we are building the leading custodian and interface for those institutional investors to interact with a decentralized financial system, or to interact with a crypto ecosystem. And all of this we do in a secure and regulated way. And if you take a look of what we do in particular, so think of us a little bit like a traditional banking interface, a traditional banking solution. But instead of just managing like your stocks or your bonds, we are actually managing your digital assets, be it Bitcoin, be it Ethereum, but it's a broad range of crypto assets, cryptocurrencies, however you want to call them. And we try to get the investors, the users, a very similar experience to what they're used from the old traditional banking system. So the core product we started with was the custody part, because again, security is more important than return. And I think there's one behavioral finance anecdote I always like to use. If you lose €5, it hurts you way more than if you win €5, or if you enjoy winning €5. And this is a little bit especially true for institutional investors. So their first goal is to keep the money safe, to preserve the capital, and then they are thinking about return opportunities. And this explains also why we started with the custody part, because that was and that still is the biggest problem for institutional investors. Obviously, once you say, okay, I'm a custodian, your customers ask, okay, what's next? Because custody technically is a very, very boring product, right? So you can send money in, it's safeguarded, it's secure, and you can send money out. Think of a bank vault. You don't have a lot of interaction with your bank vault, but the obvious step, and this is what we had in mind from the very early days, is to develop a platform, and a platform from where you, as an investor, as a professional, as an institutional investor, can also benefit from all the opportunities which are out there in the ecosystem. So we started to offer staking in 2020. And we also started to offer trading over the course of last year. And what you should think of us is, and we see that later a little bit, like an interface which enables you to do everything which is out there in the crypto ecosystem. What did we solve by that? And remember, the three problems I showed you before was trust, usability, and agility. And I mean by the fact that we are a secure platform based in Germany and regulated in Germany, customers really entrust us with their millions and their billions of capital. And we are basically their bank. Yeah? We are, on the one hand side, showing them, yes, you can trust into the blockchain technology if you think back on the building blocks. And on the other hand, they also trust in us as an institution because we are regulated. We try to have that for the user as friendly and as simple as possible. And this is really a big challenge because, as I said, the crypto ecosystem is completely different from what we have been seeing before. And it's way more technical. So you have to combine the technical aspect of it, but also the used interfaces and the used processes they know from the traditional world. And I think one very, very key aspect of what's important for our customers is what we here call agility. Is basically to give them access to all those things which are out there. And I mean, you heard that in the previous sessions, the crypto market is moving super, super fast. There are new things coming out every week, every month. And the important thing for us is, as a secure and trusted environment, we also need to choose what do we offer our customers and when. How do we do our due diligence process? And I think this is something which you can also see as a USP, that combining the security aspect, but also combining the agility and the innovative aspect of this ecosystem. Maybe coming to the end, also looking at the time a little bit, you might now ask, okay, those guys might be building an intermediary in a decentralized system, right? And this is exactly what we are not trying to do. So we have a DNA which is very, very decentralized. And this is also one of our, let's say, key success factors if you compare us to other custodians like Coinbase, for example. So we really preach and live collaboration and openness. And we do not want to be seen as an intermediary, like a big block in a decentralized system, but we rather want to be seen as an interface, as a gateway into the market. And I mean, we could talk about technology, how we're going to solve that, but just a couple of sentences, like we do not hold the private key for the customers, which some custodians do, but we basically safeguard the private key that the customer can really use and leverage the private key. So you should not think of us as, okay, those guys are controlling my money. We're rather giving them an infrastructure, an interface for them to make the most out of their money. And this is a little bit, think of this slide as a little bit like, a layered slide. So what we want to do is we connect the crypto ecosystem to the customers by offering products like custody, trading, staking, governance, lending, investments, and so on and so on. So don't see or don't look at us as a custodian who's let's say holding the money and whom you have to trust, but you rather have to trust into the technology we have built. And you are still the manager of your own capital. You own the keys. I shouldn't say that in that way, but you control the keys in a way. And we are basically just the interface, the connection for the customer to the layer 1 networks, the layer 2 solutions, the decentralized apps like decentralized exchanges, or the staking validators, for example. And ending this with a last slide, what's on the roadmap? So we do this at the moment mostly for digital financial assets. Because most of the digital assets you see nowadays are rather financial assets. Bitcoin is seen as a cryptocurrency. You have utility tokens and so on and so on. But I think if we all believe in a tokenized environment, a lot of the things in this world will be powered by tokens. NFTs, so non-fungible tokens. You've seen digital art. But we can also talk about virtual reality assets, which might be tokenized. We might talk about data, which might be stored decentralized in the form of tokens. And we even might talk about the digital identity. And everything which can be tokenized, which has a private key, this is basically something which we imagine to be managed via a platform, via an interface. And this is also the anecdote on the right-hand side. So yes, you can think of us maybe as a Google in the Web3 world, but as said, not an intermediary, but rather the interface, the access point into the world of digital assets or digital tokens. And I think looking at the time, we have 15 minutes for Q&A. So thank you very much for listening. And I hope it was interesting. If you want to know more, I think, yes, you can reach out over here. And I think Yip, she can also share my email address later.
Yes, of course. Thanks a lot, Chris. Maybe you start off sharing with us, how did you actually get fascinated to enter the crypto world? What was your personal story? You've been in there for quite a while, even while you were at McKinsey.
Good question. I think you can see me again. So very simple story. So it was January 2017, like very, very early days, German winter, came home from a banking study from Zurich. A friend called me on a Thursday night and said, I've been reading about Bitcoin for the last 3 months, you should buy. And I basically said, where and how much. So I didn't really ask what it is. I just bought and got fascinated about it from an investment perspective the first couple of weeks. So I used to trade stocks since I was 17. So always was very interested in financial markets, into trading, and the crypto volatility, the trading part of it was what really got me into the market. And in the first, let's say, weeks, months, it was rather for me, let's call it gambling, than really understanding the technology. But at some point in time, I said, okay, I'm spending so much time in it, and I'm working with banks at McKinsey, and you always hear, okay, yeah, we have this problem in IT, and we put this on the IT roadmap for 2021, 2022, and remember it was 2017, and dig more and more into the concept of decentralized networks, blockchains, etc., etc. And at some point in time, it just made click that I thought, okay, this has a disruptive potential. So not only in the financial industry, but also in a couple of other industries. So spend more and more time in it, spend time and money. So invested a lot. And at some point in time, at the end of 2017, I think I owned like 80, 85 different tokens. And I was basically missing this platform and missing this interface where I could trade my tokens, where I could store my tokens, and all those stories you might have read in the newspapers of hacks, people losing their private keys. That really happened, because that also happened to me. So there's still a wallet where I do not have the private key anymore. So luckily it's not that much money. But those stories are true. And we said, okay, if we are really facing those pain points, there must be other people out there who are also facing those pain points. And this is then how we got to the idea of Finoa, quit our McKinsey jobs, and the rest played out very, very well. Although 2018 and 2019, I mean, you can also be that transparent. In crypto winter, not a lot of people believed into this. So the first years were also quite tough, trying to convince people what we really do. Like a lot of my friends, not friends, but people I know said, I have no clue what you're doing, and I have no clue why you're doing that. Kind of, are you crazy? But I mean, we always had a very strong belief in the ecosystem, in the technology, and also in what we do, that there's a product market fit. And I think, luckily we came so far. And I think it's just, there's still a lot of plans to be hopefully executed.
Amazing. So we have a question from Tom who says, oh no, wait, the first question from Ash, why wouldn't the investors hold the private keys personally instead? And I think while you answer this question, maybe you can share also about the alternatives of if like, you don't want to keep your nano ledger at the office, but what else did people do, high net worth individuals, before there were like these custodians?
I mean, you have to separate between institutional investors and individual investors a bit. So yes, what you see is that most of the individual investors are able to hold their keys on their own up to a certain amount of money, because at some point in time it becomes so much money that people don't really feel comfortable to have the ledger at home, for example. And I think this is rather for the people who are not very, very crypto native, but for the normal investors. So we also have a couple of individual investors who have millions of euros or US dollars stored with us. And I think there are two components of it. So on the one hand side, it's if you have a nano ledger, where do you have it? Do you have it at home? Do you put it in a bank safe? Let's assume you put it in a bank safe, and then you want to trade. So at night, you run to your bank, which is closed. You have no access to your ledger, so you can't really trade in a market which is like this. And if you are not like a long-term holder and don't want to touch your assets for the next 5 years, this is not the right solution. Why do institutional investors not use the ledger? Because it's very, very difficult for them to fulfill the government's requirements. And I mean, you also read those stories in the newspaper that at one point in time, there was like one of the 3 investment managers in the fund is not coming to work anymore, and the wallets are empty. So who takes the ledger home at night? This is also a problem which people had in 2017 and 2018. So yes, they used the ledger, and then one of the guys took the ledger home. And the other 2 or 3 or however are working in the fund basically had to trust this person. And I think what you also don't read so much in newspaper, but there were also investment funds who got, let's say, attacked, i.e. kidnapped in their own office by arm people, because those people actually knew that the money was on the ledger and was in the offices. So the thing is, you do not want to hold those keys on your own as an institutional investors, but you rather want to have a third party you can also claim who is liable if the assets are gone, and so on and so on. And I mean, there are plenty of stories and there are plenty of sales arguments, but in the end, it comes down to the point, how technical are you as a user? Can you do that on your own? And the second question is, are you allowed to do that on your own with multi-signature, with 2 out of 3 people having to confirm a transaction? So we have customers where 9 people have to sign a transaction request so that the transaction is really going down. And all of this is not possible with most of the self-custody solutions. Yes, there are a couple of ones where this is possible, but in general, yeah, institutional investors do not want to hold their own keys. Just imagine a 65-year-old family officer. He's not most probably the most tech savvy guy, so he wants to have this outsourced to a third party.
And how do you keep the keys safe from hackers? Talk here.
That's a good question. So I'm a business guy. I can explain the concept. So we use with hardware security modules. Hardware security modules are basically devices of this size. In theory, they are unhackable. And in those hardware security modules, we create the private keys to the public address. We keep the private key in there, and the private key never leaves the hardware security module. And those hardware security modules, then obviously you have to store physically. And we have them stored in typical banking, military grade data centers. So deep down in the vaults, and always connected to the internet, so they are always available. But basically think of it, it's kind of a hardware disk where the private keys are saved. We can access those private keys to initiate transactions. So it's kind of a cold storage, but it has an accessibility of a hot storage solution. So if customers want to trade, it's happening immediately, or if they want to transfer something. But this is very, let's say, the highest standard of cybersecurity. Yes, we are getting attacked regularly, unfortunately, but this is basically the nature of the game. Yeah.
So imagine, just for us to understand, how does it actually look like behind the curtains, right? So there's a project that you want to provide custody for, let's say Solana or Unit in the future. How do you actually select the good projects in the market? Like, how do you decide which out of the thousands of tokens are out there that you want to integrate to your portfolio service?
Yeah, very good question. And I think this is very, very important business decision as well, because I mean, you have so-called layer 1 protocols and then the layer 2 applications on top of that. So layer 1 protocols are, for example, Bitcoin, Ethereum, Solana, Polkadot/Substrate, and so on and so on. And one layer 1 protocol usually takes 3 months for us to integrate into our infrastructure. And this is for a custodian already very fast. So some of the custodians out there, they need a little bit longer, let's put it this way. So this is always a huge investment, not so much from the financial perspective, but from the FTE perspective, right? And we have like I would say, standardized framework, which is very close to how VCs actually would evaluate a project. So we take a look at, do we believe at the use case, first of all? Do we believe in the technology? So we always do like a tech due diligence of the blockchain, of the network. Do we believe in the team? And then obviously, who else has invested into this project? So is it like the most reputable venture capital funds in this world, or are it some funds you don't know, or is it actually nobody? So we really go like, okay, what is the reputation in the market? Because this explains you also a little bit like what's the community looking like. And I think the obviously important thing for us is as well what is the economic opportunity? So do we believe in the growth on the short and on the long-term aspect? And are we also able to win the customers who have invested into the project? Because it doesn't make sense if we integrate a token, but none of the investors would actually store the tokens with us. So it's also a little bit like, who is invested? Do we have a relationship to them? Or are we able to build a relationship, and are they trusting us with their tokens? And I mean, those 5-6 things are usually the things we're going to take a look at. I think most importantly, it's, are we able to integrate this in a certain amount of time, and also what is the most interesting project over the long run? And obviously, as you might know, there are not so many custodians out there in the world who offer the services we do. So we get, let's say, 5 times the requests of tokens to be integrated than what we are able to execute. So we really have like the choice and really can select the projects we really want to work with. And unfortunately, yes, as a startup, you don't have unlimited resources, especially not in terms of developers who work in that space. So if anybody of you is a developer, I'm more than happy to talk. So you have to say more often no than you would like to say no. Let's put it this way.
Yay, can vouch for Chris being a really good, co-worker, or probably a very good boss. Somebody asked, Tom asked, what are the crypto funds investing in? What are the latest trends in the market that you're seeing?
Yeah. I mean, the first thing you have to know is crypto funds are not investing into Bitcoin and Ethereum, because crypto funds usually manage capital from other institutional investors. And those other institutional investors expect the crypto funds to beat the market, so to outperform the market in terms of yield or return. So if you would just want to cover the market, yes, you can invest into Bitcoin and Ethereum, but most of those, let's say, crypto funds, crypto VCs, they invest into the long tail of the projects. And I think what you have been seeing in the year 2020 was that a lot of VCs invested into the Ethereum attackers, so all the layer 1 protocols, the native blockchains, which promised a higher scalability and faster and cheaper transactions like than Ethereum. So you saw a lot of those coming to the market, a lot of them also increasing their community, getting more and more projects being built on. So to name a few was Near, it was Polkadot, which saw a lot of attention. It was Flow, so the blockchain from DeFi Labs, which is basically the underlying protocol, especially for the NFT space. So CryptoKitties, it's the team from which also built CryptoKitties. They also developed the Flow blockchain. So this is on the underlying technology on the blockchain side. I think what you nowadays see is that a lot of VCs invest into the financial applications on top of it. So decentralized exchanges, lending platforms, uncollateralized lending, collateralized lending. So I think if you take a look at the decentralized financial space, a lot of the stuff which is built is there to replace the traditional financial world. And I think this is also very, very much liked by the VC investors. You see a lot in the, let's say, NFT gamification space, which is very interesting for the VCs. And I think what's also coming more and more, and there's a very interesting project in Berlin, which is called Centrifuge. They are basically bringing the real world assets onto the blockchain. So you use basically you tokenize real world assets, like, for example, factoring bills or contracts. And by that, basically, you bring liquidity out of the crypto world into a different market. And I think there are a lot of interesting use cases on the one hand side, rebuilding the old financial system, but also, let's say, connecting the two worlds. And I think from the layer one side, there might be the end at some point in time, that there are not coming so many new blockchain protocols. But I think on the application side, on the decentralized application side, the ideas we are right now seeing, it's just the beginning. And I mean, just imagine, like, we are in the market for 10, 11 years, and we are in the early 2000s of the internet. And I mean, when did Amazon really become big? It was maybe 2010, 2012. And they were also 12, 14, maybe even a couple of years longer in the game. So what we see in the 20s, in the 30s, that's really what's shaping blockchain. So a lot of people ask me, am I too late? And I say, no, you're by far not too late. Because if I talk to friends of mine in banking, in private equity, in consulting, there's still very, very few who know about blockchain and to really understand it. And I would say they are on the smarter side of things. So I think there's still a lot of stuff which we're going to see, which is built. And yeah, just encourage you to think what could be the next thing.
Yeah, where do you see the blank spots? What needs to be built most urgently?
If I knew that, then I would do that maybe on the side. Very good question. I mean, there are a couple of things. So I think what I really like is those projects who have a connection to the traditional world, because what you see in the market right now is, yes, you have this crypto ecosystem, you still have the traditional world, and you just have to take a look around the world. China, US, European Union, regulators are afraid of what crypto is and how crypto evolves. And you have a couple of regulatory efforts, regulatory drafts, which are rather there to destroy this ecosystem. And this makes me also think, as much as I'm idealist on the decentralization side, and I think you figured that out by now, I think the real value in the technology will also come from bringing this technology into more traditional industries. And I mean, building those connections, like Centrifuge, for example, does, like also having like a real use case, which traditional industries, which people can use. This is something which I think is a very, very interesting side of things. Yes, it might not be the most disruptive part, but it's something which really has like a very good chance of success, which also has a value. And I mean, if you take a look at the very, let's say, disruptive decentralized space, there are a lot of things which I think are very interesting. So decentralized insurance, decentralized data, those kind of things, decentralized trust, like zero knowledge proof, if people have heard of that. So in that space, there's a lot of stuff which is still happening, and where are still white spots and opportunities. Yes, there are teams working on, but as said, I think we're still in the early days, and there's still a lot of room to grow.
If you were to pick one use case that needs to be developed, what would you pick? Like, if you could just shape the world in the most bold way that you would imagine, by 2030, what would we have built?
I'm a financial service guy, so I think there's one project which is really, or let's say one category which I'm a big fan of, which is decentralized exchanges with automated market makers. And I think if this becomes mainstream, this is really revolutionary, because you're taking out the middleman, i.e. the exchange, and you basically facilitate peer-to-peer trading solely based on technology, on algorithms. And the interesting thing is that If you're on an exchange, basically what does the exchange do? They match supply and demand. If there's no supply and demand, which is matching, you basically have a market maker. This market maker then takes the order, so either buys or sells, and he has an obligation to do that. And therewith, he actually makes, or they make a lot of money with it. And the interesting part, and Balancer, for example, does that. The interesting part of this is that in the crypto ecosystem, there is no exchange like the German exchange in Frankfurt, Deutsche Börse. But the algorithm is basically matching supply and demand. And if there's no market maker, everybody in the crypto community can be the market maker. So if you hold 2 coins, and currently it's only built on Ethereum, so 2 ERC20 coins, for example, and you want to become the market maker, you can supply your liquidity, and then people can trade against you, and you are getting the fees. And I think this is a super, super nice example how you can take out intermediaries and how a system can run 24/7 without any outages. And I mean, this, if you think back like the Robinhood GameStop disaster, which we had earlier this year, so the market can't be stopped if it's a decentralized system. And I think this is something which I'm very, very passionate about. And this also relates a little bit to what we are trying to build. So I would be the most happy person in this world if we are able to integrate a decentralized exchange and enable our customers to trade on this decentralized exchange. But this is also a problem in terms of regulatory aspects as of right now, because anti-money laundering and all those things are very, very difficult to comply with if you don't really know your counterparty and don't know where the money is coming from. And I think this is why I said in the beginning, this is a very interesting aspect. How are you able to merge those 2 ecosystems? And I think this is the way, or the big question we will see, because if you asked in the next 10 years until 2030, that's really the biggest question for me. How can we get this technology and obviously the benefits of this technology into the real world? Like, how did we get the internet into the real world, and how can we actually do this with a blockchain technology?
Beautiful, beautiful outlook for the future. And thanks for giving us this question that we can now contemplate actually in the breakout room. So I'm opening them up. I put 6 minutes for you to just exchange your key takeaways from the session, and then let's come back and do an official wrap up. Thank you very much, Chris, for joining us and sharing your insights. I will share your contact details with the group later on, and then everybody, you're free to recommend your favorite developers or whatever. Send them Chris' way. All right.
Waiting
Have a
for
good one, Chris. And
Thank
I'm
you very
opening up
much.
breakout rooms.
Ciao.
Ciao.